Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, you're in for a massive episode today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. It must be getting winter in Australia.
Why's that?
Because one hallmark of winter in Australia is everyone flies to Europe.
This is a stretch if ever I've heard it.
And what we have seen in the global stock market is a massive flight to Europe.
Wow.
Do you like that?
That's pretty good. That's pretty good. Well, in today's episode, yes, we're going to cover off what is happening in markets, particularly overnight at the time of recording. There was a US tech sell-off, so we're going to cover that. I'm going to give you an update on where I'm at with my $500 to $5,000 challenge, and then we're going to close out with a question from a community member around the latest Vanguard diversified all-growth ETF and how it compares to some of the competitors.
But before we get into it, we want to remind everyone of the new show that we launched this week, Basis Points by Equity Mates. Wherever you're watching or listening to this, search Basis Points and you'll be able to find the show. It is specifically targeted for financial advisors, but available for everyone to listen to. We're going to be speaking to some of the best fund managers and best financial advisors in Australia and around the world to identify or to try and find those small improvements that can compound into big outcomes. So come and join, subscribe, and give it a listen and let us know what you think because we're pretty excited about it.
News and markets.
So, Ren, earlier this week, the news that I guess rattled us as we woke up was that the US tech stocks were selling off.
Rattled you. Got me. I was excited. I had 2 Instagram posts out the door by 8 a.m.
You did. So just to put some context to it, last week was the worst week for the S&P 500 in 2 years, and Monday was the worst day in some time.
I think for the NASDAQ, the worst day in 2 years as well.
Yeah, so I think it was, it shed about 4%. The NASDAQ is the US tech it's the exchange that has most of the US tech giants on it. But Ren, you have a bit of a quote that you brought up before recording that is a good reminder for instances like this.
Yeah, this is the worst crash since the last crash you no longer remember.
October 2023, was it?
Well, no, they're saying it's the worst day since a day in 2022. It's like, but no one remembers that. Yeah. If you had sold in 2022 and you hadn't got back in the market, you would have left some money on the table as well.
Yeah.
There's some stats. So since 1928 in the US, the US market falls 10% on average once every 11 months.
Nice, yeah.
The US market, the S&P 500, since its recent high in February, is down about 9%.
Yeah.
So this is like absolutely bang average, par for the course. And similarly, the US market falls 20% once every 4 years. So even if it gets worse from here, it's just a reminder that like this is what happens when you're investing in stocks. It is bang average. It is normal. It is not to panic about, but you wouldn't know that if you looked at financial media.
Yes.
You know, $750 billion lost, worst day in years, panic, like they're the headlines. But that's because the media incentive is to get clicks.
Yeah.
Downloads, they make money.
Which is why we're starting our show with it as well.
Yeah. Well, I think that is the context in which we want to talk about this because it's important to remember that like this isn't unusual.
Yeah.
But what these moments become are buying opportunities. And it might fall further from here.
Yeah.
We're not saying this is the bottom, but like start thinking buying opportunity.
Absolutely. Well, we're going to have a look at some of the stocks that have really taken a tumble in a moment, but it's worth just touching on why this is happening. Sort of 3 key reasons. Obviously, Trump is really out there pushing his tariff agenda, and the market is, I guess, digesting what that actually means. Whether or not they're all going to come to fruition.
Yes.
And B, if they do come to fruition, what impact that is going to have on economies around the world. The second component is Trump has acknowledged that some of his policies might actually cause a recession. That is what's getting markets most worried, and that's what we saw really come through earlier this week. But also, Ren, the way you started the show, there is a rotation now out of the US stocks into Europe, into the UK, and also into China as well.
And we've been speaking about this on the podcast this year. You know, we did that segment on European stocks ripping. The European stocks 600 index is up over 10%, whereas Australia and the US is basically flat. Well, then it was flat. Now the US is down. China, well, not China, but Hong Kong is up, what? It was 17%. And we've spoken about that. So it's a reminder that over the long history of the stock market, different markets will have different decades where they outperform. Australia has had a couple of decades where it's been the best performer. The US is obviously, different European markets have. But it's rare that markets go back to back. And so the 2010s was the US's decade, no doubt. And the 2020s started pretty well for the US as well. But like this is just the normal functioning of markets. And so there's a lot of panic out there, but not a lot of reasons to panic, I would say.
How long will Trump let it last, though? Because he loves the stock market.
He does.
It's his indicator of success. But anyway, let's have a look at some of the companies that have fallen. You said there might be some buying opportunities out there. We'll start with the mega tech companies.
Yeah, so as we said, the headline was $750 billion wiped out in a day, but obviously those raw numbers, that headline gets bigger as these companies just get bigger. From a percentage point of view, Apple down 5%, Microsoft down 4%, Nvidia down 5%, Meta down 5%, Amazon down 3%, Alphabet down 5%, Tesla down 15%.
Love to see it.
So that's the Magnificent Seven. Tesla's halved its value.
In the last month, it's down 36%.
Yeah.
It's wild.
Yeah.
Yeah, it's almost wiped its entire gains for the last year. For the last 12 months.
Yeah.
Yeah. I think people are using that stock as a voting machine against Elon at the moment. That's pretty clear.
Yeah, well, I also think a number of potential car purchasers are using their wallet as a voting machine,
absolutely.
especially in Europe, as we've spoken about. Sales are down across the board.
Yeah.
Did you see that that photo from one of the Tesla factories? And it was like an office window, and someone hung a sign out the window saying, "We hate him too."
Really?
Yeah.
Wow. I get, yeah. Yeah, it's going to be fascinating to see what happens with all of this. But anyway, those are the big tech stocks, but it didn't stop there. Some other notable names. Reddit was probably one of the biggest fallers, or was the biggest faller on the S&P 500, down 20%, along with Robinhood down 20%. Palantir down 10%, Affirm down 10%, Novo Nordisk down 9%, Eli Lilly down 5%. Which is pretty interesting.
That Eli Lilly didn't fall as far.
Yes. Yes. ASML down 7%. The big investment banks, Morgan Stanley, Wells Fargo down 6%. Goldman down 5%. Doesn't stop there though. China Tech, PDD down 4%. Tencent down 4%. Alibaba down 6%. Walmart down 4%. And of course, cryptocurrency, Bitcoin fell below 80,000 USD. So Coinbase was down 18%, and MicroStrategy, or Strategy as it's now called, was down 17%.
Yeah, ironically, Bitcoin was only down 2% on the day, but Bitcoin's fall happened earlier. It was down, like 13% in the past 5 days.
Yeah. So, look, some pretty interesting opportunities there to keep an eye on.
Well, let's close this segment out. Well, we should say not everything went down. A few stocks went up. Anything European went up. The European, but listed in... Sorry, that's not true, because Spotify was down 8%.
True. Yeah.
But we definitely saw a flight to Europe. You can see a lot of the, I guess, more boring European brands went up. You know, Nestle was up, Unilever was up. Bit of a flight to safety, and also
a lot of energy was up.
Yeah. Exxon was probably had one of the better days. It was up 3%. That's obviously American. But yeah, I think we would call this a flight to Europe, a flight to safety, and a flight out of tech.
Yeah, big time.
Berkshire Hathaway up 0.3%.
Yes, love
slow and steady, Buffett. Slow and steady.
It's up 10% year to date.
Slow and steady.
Yeah.
So let's close this segment out. Obviously, everything we speak about here is general advice only. We're not aware of your personal financial circumstances. But what stocks are top of your watch list if this does become a bit of a buying opportunity?
Well, I'm loving Eli and Novo. Good opportunities there. Reddit was an interesting one when I saw it.
We spoke about that on a recent episode.
Yeah.
Scott Galloway's been going on about it.
Yeah, it's pretty compelling, 20%. Like, I'm tempted with the tech, but like, I'm happy. I don't think I'm going to jump into them. I think I'm just going to keep getting exposure through my index funds, but I don't think I'll try and overweight any of them, particularly if there is a genuine flight out of them for a while. I'm kind of happy just to see how this plays out at the moment.
Interesting.
Yeah, and maybe focus on some of the non-tech opportunities that we spoke about.
Yeah.
Yeah. What about you?
I mean, for me, Alphabet, it's trading at like a 20 PE now.
Yeah.
It's just, for me, that's one. What I'm not going to do is probably just as important as what I am going to do. I'm not going to chase Europe. So in our core portfolios, we have 4 ETFs, and one of those 4 is a mainland Europe and the UK ETF. And so we get exposure to Europe that way. I'm not going to now try and chase the hot hand and chase European stocks unless I think they're compelling.
Yeah.
Because a lot of them are pretty slow growing consumer staples or industrials, you know?
This might flow into the next segment, Ren, but I am actually pretty tempted on a little bit more in Bitcoin as well.
Okay, well, let's pause there because that does flow into the next segment. So we're going to take a quick break here, and then Bryce is going to update us on his quixotic journey to 10 bag in a year to turn $500 into $5,000.
Check, 1, 2. Come on with 10 bagging. 500 to 5K. Follow the journey. Yeah, if you wanna flip the funds, Bryce will show you how it's done.
Can Bryce 10 times his money in a year? He thinks so. Let's find out.
All right, Ren, bit of an update for my challenge. I'm trying to turn $500 into $5,000, no easy feat, in 12 months by the end of December 2025.
Okay.
To do that, I need to be getting, on average, a 23% return per month.
Yes.
Also not an easy feat.
No.
Now, I finished February just slightly off track. 21% was my return.
Okay, that's good.
I was pretty happy with that.
Yeah.
Bit of a roller coaster. So Super Micro, I was in on that. At its peak, I was up 120% on Super Micro.
Nice, okay.
I did not cash out. I'm only up 35% on that position.
No.
I know.
Are you still going to hold it?
Well, let me get to that. Yeah. So I'm up 35% on Super Micro, but the largest position in my portfolio, which is about 80% of the portfolio, is in a gold exploration mining company called Antipa Minerals, AZY. I'm still holding that. Luckily, I got in on that when the Aussie market dropped about 4%, I'm going to say about 6 to 8 weeks ago. And it is just sitting there, the very low liquidity on this stock. So I'm up on that about 25%, and it's really just holding stable. The whole thesis for this is that it just gets a buyout.
Yeah, but if it gets a buyout in 6 months, even if it's at like double, the time is...
I know.
Yeah.
I know.
Yeah, unless you think that it's going to get bought out for like 5 times or more, you need to move.
I know.
Yeah.
This is the challenge. So the lack of momentum is really starting to play on my mind, because the further I fall behind this 23%, crazy things I'm going to have to try and do to catch up.
So what are you going to do?
So I called Luke Clarity because he was the one who brought my attention to AZY through his good research. So I called him to ask him what characteristics should I be looking for in a 10-bagger, and if he had any other tips. So let's take a listen. Luke, how are you?
Brycey, how are you, bro?
I'm good. I know you're actually on the way to the airport to jump in a plane to Perth to try and find your own 10-baggers. So where should I start?
You know, you can try and find a multi-year 10-bagger, but that's going to be no good for you, right? So finding some high-quality compounder with, high return on capital and all that stuff is going to take too long. So, REA is a good business. It's been a 10-bagger, but we can't really learn a lot from that if we're trying to do things quickly. So realistically, you've got to be going down the market cap where a 10-bagger happens a lot more frequently and is a lot easier to achieve. You don't need to do as much. So it's easy to go from a 2 mil market cap to a 20, or a 20 to 100, or even a 100 to to 500 or a bill. So you need to be either in sort of resources businesses, mining types sort of businesses, exploration stories. You're going to be in, biotechs and unproven drugs that are exposed to drug trials and those kind of things. You're going to be in, emerging technology businesses, maybe with the first sniff of some revenue and a commercialisation opportunity ahead of them, and you've got to back management in to be able to continually make sales and be able to evaluate, what's in the price and what's not. Are these people good operators? Are they not?
The current position in my portfolio, AZY, about 80% I got from your good research. Long story short, cut to the chase. Any other things on the radar?
To actually achieve this goal, you need to worry about doubling your money. Yeah. After you've doubled your money, you can start actually trying to think about achieving the goal. But if you can't double your money, then there's no point talking about anything else. So that's why I've given you Antipa as a bit of a, something where we think is near-term catalyst. And I think it's going to happen this year. So I think if you're looking for something else that's got, sort of 10 bag potential, really high impact, currently, with catalysts, is I would say Strata Minerals, SMX. So, I'd say Antipa's a gold developer. They've got a higher market cap. They're further down the road. They've got a JORC resource. Yeah. Strata are just drilling right now. So they just started drilling a week and a half ago, 2 weeks ago. They're up against the boundary of Ramelius's Penny deposit, and they're literally drilling right on the boundary. The way we've seen the geology and the kind of the way that the geologists we've been talking to have been looking at it, it looks like it just continues at depth. We think they can intersect it at depth on their property, and as Ramelius have done on other parts of the same property, when neighbours have had hits, they just acquired them. So we think that, eventually, assuming Strata does get a hit, which is a big assumption because, it's a one hole, deep hole, expensive hole, high risk, but, potentially high impact in terms of value adding for shareholders. You're getting it now at like a sub 10 mil market cap. We took it in the placement recently. I think it was at 3 cents, and then it's at 4 cents now, I think, roughly. Under 10 mil market cap, and you're going to be in a position where if that drilling comes in the next, say, like by the time they finish the drilling and do the assays, it's another 8 weeks or so, maybe a bit fraction longer. If that hits, if they have, good gold intercept there, that thing could be like 50 mil market cap overnight.
Wow. Okay. So so just so for my own learning, like the drill process really, 6 weeks, and then labs and bits and pieces. So yeah. So
you can't just apply that blanket though, right?
Of course,
where they're drilling, what the rock they're drilling through, what kind of drill core what kind of drilling is it, diamond or RC, or what are they doing, and then also how deep they're going. Obviously, it takes longer to go deeper. So and then it goes, once they've got the core, then it will come up and it will get sent off to the labs. So like an ALS. You guys probably know ALQ on the ASX, someone like them, and they do laboratory analysing.
Nice. And will you be putting a report on Good Research?
It's going on Good Research this week, my friends. I think, in fact, by the time people are listening to this, I think it will already be up.
Nice.
So if you subscribe, you'll get access to that report.
The upside here, if the drilling goes well, as you said, 7 mil market cap or thereabouts, pretty decent upside. What do you think about the downside if the drilling comes out to be a waste, or just not the result they need? Like,
you're going to be in a position where they're going to need to do a discounted cap raise. The share price will probably sell off. An ASX listed company is worth kind of $2 to $3 million just with no assets and no cash and nothing in it.
Right.
So, our view is like, if you can buy stuff at, Shell plus type valuations. All you're kind of giving up is the values is a Shell. And Peter Woods, who runs Strata, is a good mate of mine. Really good guy, honest.
Nice. We'll love it, Luke. I've got some shuffling to do in the portfolio. I think I still got to decide what to do with Super Micro so I can fit this in. And then I think I want to get my weightings a bit more 50-50, I reckon, rather than 80-20. But we'll see.
You've made some good money on Antipa. You can take a little bit of profit out of that. And you can't own more than 2 stocks if you want to achieve this.
No, I agree.
It's impossible.
So, Rin, I think the key takeaway here for me is 2 things. I'm playing in the right space for a market cap. I need to be playing sort of sub 20 million.
Well, not with Super Micro.
Not with Super Micro, no. So I'm going to get rid of Super Micro.
Okay. Yeah. But you did double Super Micro before you didn't sell. You had doubled it.
I know, but I didn't sell.
You doubled it in a month. So
120%.
Yeah.
What I actually need to do here, and this is going to be the plan for this week, is I'm going to actually sell a bit of AZY and rebalance the portfolio a bit.
Yeah.
Because having 80% of it sitting just sitting there doing not a lot, hoping for a buyout is really dragging the ability for me to put the capital elsewhere. So I'm going to sell a bit of it. I'm really tempted with Bitcoin at the moment.
Okay.
I feel like if it is hanging around this sort of sub 70s, then we could be in for a bit of a ride. As we heard, Luke thinks SMX or Strata Minerals is a potential short-term catalyst, again in gold. So I've got some thinking to do, but I know what I am going to do is get rid of Supermicro and rebalance a little bit here.
Because the rules of the game are you can invest in anything that's available on the stock market through a normal brokerage app, and then also Bitcoin and Ethereum.
That was it, yeah.
But what is available on the stock market in the US are leveraged Bitcoin ETFs.
That's true.
Would you do that? Triple leverage Bitcoin.
Now that you remind me of it, it's actually quite compelling.
God, I don't know how much clearer we can say. This is not investment advice, and this is not how we advocate investing.
No, not at all.
This is Bryce doing something quite silly for content and to see if he can do it.
100%. This is content only. The goal, I have to, at the end of the March, I need to be at $760. I'm currently at $626 or something like that. So I need to make $160 this month to still be on track, which again is at 20%. Very hard to do as well, may I point out, when the market is shedding.
Well, you could have gone triple leverage short.
I could have, and I did talk about that in the office, but it's just, I was going to say that's just such a punt, but that is exactly what I'm doing.
This whole thing is a punt.
I know.
Well, look, let's.
So I think the main thing is keep up to date on social media for weekly updates, because that's where I'll keep updating you on what I'm going to be doing weekly. Yeah.
Okay. All right. Well, Bryce's punting channel coming to. Maybe this is the start of a punting podcast. No. This is probably going to be the extent of our punting. So let's take a break here. Then on the other side of the break, let's get back to sensible long-term investing, because Vanguard have released a new globally diversified all stocks ETF. VDAL is the ticker, and we're going to compare it to some of its peers here in Australia. Are you looking for one ETF that gives you exposure to the whole world at a low cost? Well, Vanguard have an offering, but is it the best offering? That's the question we're going to be answering today. Bryce, we've got a number of community questions about Vanguard's new ETF, the Vanguard Diversified 100% All Growth Index ETF. The ticker is VDAL. And we're going to compare it to some of the popular ETFs. I think particularly its peer from Betashares, DHHF, Betashares Diversified All Growth ETF.
That's it, Ren. We have a couple of questions. The first was from Marlo via email, and he asked how it stacks up against Betashares DHHF in terms of asset allocation. So we'll have a look at that. And then the second from Trav in our Facebook discussion group, querying whether Vanguard may have left their run in this space a little late, given that there are a number of competitors already out there. Fair play.
Yeah, well, I think to answer that question first, and then we'll get to Marlowe's and compare the pair. Vanguard owned this space with VDHG.
Exactly.
And for years, Vanguard Diversified High Growth, which was 90% stock, 10% bonds, that was the one that everyone who just wanted an all-in-one ETF would go to. It was massive in the FIRE movement.
Yeah.
And then Betashares dropped DHHF, just not that long ago now.
Yeah.
And all of a sudden everyone was like, oh, well, this is actually similar, but a little bit more compelling because it's just 100% stocks.
Yeah.
So this is just Vanguard responding to competitive pressures.
Absolutely. Competitive pressure and demand. So,
and have they left it too late? No.
Definitely not.
These ETF stories are just beginning.
Just starting, yeah. We should point out here, to your point, Ren, that these all-in-one ETFs do exist. These two are getting put head-to-head because they are both 100% equities, or as in their titles, they call them all growth. So there's no allocation to fixed income, cash, or any other asset class outside of just equities.
Yeah. So let's go through it. Vanguard Diversified All Growth has 6,000 stocks, and the Betashares Diversified All Growth has 8,000 stocks. If we start with the Australian exposure, Vanguard is aiming for 40%, and Betashares is a bit below that, 36.8% at the moment. So similar exposure to Aussie. So then it gets to the international section, and the way it's constructed, like philosophically, is different here. So Vanguard have just gone, give us the world, and they've got international shares at just shy of 30%. And then international shares currency hedge, so taking the currency fluctuations out, at another 18%. So that's 48%. But then they've separated small caps out, and there's a separate allocation, 7% for small caps. So they've just said, give us the world as a whole. As different markets rise and fall, we'll just take whatever the weightings are of those markets. The Betashares construction is different. They've actually separated the US out. And so they haven't said just give us the whole world. They've said give us the US at about 40% and give us the rest of the world outside of the US, or the rest of the developed world outside of the US at 15%. And so what that will mean, like let's say in 20 years, the US is, so right now the US is 70% of the global index. That might change over time. The Vanguard ETF, your US weighting will change over time as global share markets rise and fall. In the Betashares one, your US weighting will remain around that 40% mark.
Yeah.
Which do you prefer?
Probably a better longer term strategy so you don't have to worry about it is the Vanguard one. But I prefer the DHHF.
Nice.
If that makes sense.
I think the important thing to note today is that your US exposure is similar, because if we say that you roll up those Vanguard ones, it's about 55%. And if the US is about 70% of the global index, then that works out to be about 38% weighting to the US.
Yeah.
Compared to 40% for Betashares.
Yeah.
So right now it's the same. Over time, the Vanguard one might change. The Betashares US weighting will remain, unless they actually go in and change their target weightings. Yeah.
And then to close out, they both have exposure to emerging markets. The Vanguard ETF is 5.5%, and for Betashares, it's 5.8%.
So if we pause here, I would say pretty similar. I don't think there's either of these are a bad option. I think understanding that nuance of how the US is constructed in both ETFs matters, but it only matters in the margins. So right now I would be saying, to these questions, which one would I be choosing? How does the asset allocation stack up? Like, they're all much of a muchness. And it's not a massive difference, but where the difference comes for me is fees.
Yeah. So Vanguard is 0.27% management fee, and Betashares is 0.19%. Surprising from Vanguard. I thought they would have tried to match it, or at least get a little bit closer. Maybe in there they're doing things like hedging and whatnot, so there might be, for that reason it might need to be a little bit more expensive. But if you're doing head-to-head, it's hard to go past that management fee of Betashares. Yeah,
and there are two arguments. You could say, they're both pretty low in the scheme of overall ETF fees and overall managed fund fees, like 0.19% or 0.27% are both good, sure. But the other side of the argument is, why would I pay 50% more in fees for something that is essentially the same product?
Yeah.
So whichever side of that argument you fall is completely fair. Whichever product you choose, they're both great products. But yeah, for me, DHHF, and to be honest, GHHF, the moderately geared version of this Betashares ETF, probably slightly have the edge for me. That would change if the US absolutely tanks, though.
Could do. It's good to see a bit of competition, though. So we love seeing new products come to market that just make it even easier for retail investors to build wealth over the long term. If you have a question, head to the link in the show notes or the description below. Please leave us a voice message. We love hearing from you. Or you can head to equitymates.com/contact to leave a note there.
And we should say, if you're interested in these all-in-one ETFs and how you can set up an automated investing strategy around them, we literally wrote the book on it. It's called Don't Stress, Just Invest, available on Amazon or wherever books are sold. Link is in the YouTube description and the show notes as well. So should give that a plug.
Give it a plug. That's it. Go and buy it. If you take a lot of value from what we do here at Equity Mates, we would appreciate if you could take 2 minutes to just rate our podcast and leave a review. And just a reminder to go and check out our latest show in the Equity Mates Media Network, Basis Points. It is designed for financial advisors, but accessible for everyone. Some of the content on there is really, really good. So make sure you go and check it out. It's going to be live wherever you are listening to Equity Mates right now. But Ren, that brings us to the end of today's episode. We'll pick it up next week.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.